I think there are three things for sure. There's three main macro discussion points that people should be aware of. If you're a small investor or a super large investor, the first is interest rates. Interest rates are going to remain low for the foreseeable future. What does that mean exactly? It means that debt is going to continue to be cheap and that there's going to be further pressure for cap rates to go down. And for those who don't know what a cap rate is, it's basically it's like the income of a property, like the first year's income of a property, their expected return. So if interest rates continue to stay low or go down, there will be pressure for good quality assets, that have strong rents, for the spread between the cap rate and the interest rate to go down. I think that's one major trend that people should pay attention to. The second major trend is taxes. Through COVID, I think Canada's done a fantastic job creating liquidity, but they've also added a lot of new money to the supply. They've created a lot of new money, and and I think all of the world governments are increasing their deficits, so to speak, to help pay for this short-term instability. But at the end of the day, they need to get that money back somehow. And they aren't getting it back through increasing interest rates for, like government bonds. They're clearly not getting it back from there. I think one very easy way for them to get it back is through increasing capital gains taxes or any kind of transactional tax for investing, right? For all the people who've gotten more and more money in these past few months, it's the easiest way to get it back is to tax them on their investments. So I would look out for any kind of sign of capital gains tax increase. In Canada, their budget is being put forth next year in the spring, in Q1, Q2 of next year. So that's definitely a thing to watch out for. And I think a lot of the moves people are making right now is potentially in anticipation of that. I think if capital gains goes up, if any kind of transaction tax goes up, there'll just be less trades. It won't make the underlying value of the asset or the real estate worth less. In fact, it'll make it worth more because for anyone to sell, they're going to have to sell for more to get a certain return if their taxes are up. So I think it'll make things more expensive for good quality stuff. Obviously, for stuff that's not desirable or has issues, then that stuff will probably go down. But for stuff that's super desirable, multifamily, industrial, super stable, super safe, grocery, those will be harder and harder to trade. And the people who own that stuff will probably be in the best position. I'd say the third trend is immigration growth. Another way that I'd say the Canadian government can pay for a lot of this deficit, and the way it historically has, is just through immigration. And that's and immigrants bring money, they bring capital, and they also, increase the GDP of the country. So I think that's generally a positive sentiment for Canada, increase immigration, because that will increase growth overall. So I think that's another major trend to look out for.